So we can see the price return into the inefficiency. Price took out all the buy side's liquidity, return into the inefficiency that is within the premium price zone. And now we can see we have the rejection to the downside. So the next thing you're going to identify is that price gave us this bearish impulsive move to the downside and then took out this low point. So what we have is price broke the swing low point we've seen here, further leading now to a bearish market condition. So what you can see and identify is that we have the bullish move to the upside and then price gave the impulsive leg move that's called this swing low point. So this is actually now our order flow zone from the swing low points here to the swing high points here. Welcome to the 9th episode of the mentorship program. In this particular episode, we're going to be looking at institutional order flow, understanding the directional flow of orders from institutional traders is actually crucial as it often determines the direction of the market trends. Institutional traders have the capital to actually move the market significantly, and thus their trading activities often create new trends or reversal in the existing trends. So analyzing institutional order flow can provide we retail traders with clues about potential upcoming market conditions, allowing us retail traders to actually position our trades accordingly. So the institutional order flow is essentially the mechanism of how the buy and sell orders from institutional traders actually influence the price action in the Forex markets. So we must understand that this influence is actually substantial as it has the power to create significant market movements. Knowing the direction of institutional order flow allows the retail traders, basically you and I, to align our trading strategies with the big players in the markets. If you can remember, there is an episode that talks about the players in the Forex markets. So the institutional order flow allows us, the retail traders, to actually align our trading strategy with the big players in the financial markets, potentially leading to more profitable trades for us because we are actually trading from the perspective of the institutional traders. So we're going to be looking at the institutional order flow. So you can see here, we actually have a bullish market condition, and then we basically have a bullish institutional order flow in this condition. Now, the institutional order flow basically is actually the opposing markets movements in a particular directional bias. Because now what you can see here, we actually have a bullish market condition. So you can see we have the push of price to the outside, price created this high. And then you can see we have a minor market structure, which is actually bearish in condition. And then we have the impulsive leg move of price to the upside that took out the swing high points. So we have price created a high points, and then we have price created a low points here. So we have the impulsive leg move to the upside that took out this high points. So now what you can understand and see is in the pullback leg move, which is actually bearish in nature, we actually have the pullback leg move as actually the price delivery we must pay attention to as the order flow. So, but in this condition, in the pullback leg move, what you can see is we pay attention to the last bearish move that created the low points before the impulsive leg move to the upside that further pushed to the upside to take out the swing high points. So that is actually where we marked out the order flow zone. So you must understand that we have the order flow, and then we also have the order blocks. As we continue, we're going to actually look at the order blocks. When we talk about sponsorship candles, we looked at the order blocks, and then we look at the fair value gaps and other sponsorship candles. So what you can see, we now have the order flow. We have the sell move before the impulsive bullish move that took out the high points that led to the break in market structure. So we have the rate of this sell side liquidity, and then we have price push to the upside and raided the minor structure high points, and in extension we have price took out the major structure swing points here. So you can see this is where we have the order flow. This is where we have the last sell move before the impulsive buy move that took out the external range liquidity. As we continue further, in next episode, we're going to look at the liquidity pools, the buy side liquidity, the sell side liquidity. We're going to look at sponsorship candles like the breaker and mitigation blocks. But for this particular episode, I just want you guys to understand identification of the institutional order flow. So now you can see this is our order flow zone from this swing high to this swing low, because this is the last corrective leg move before the impulsive leg move that took out the swing high points. Now what we're going to see is price will return into the order flow. So we have scenarios in the market which we're going to check out, real-time chart example, where you would find out that the market will return into the order flow and not necessarily back into the order blocks. So now you can see that now we have the push of price to the upside, and then we have the return of price into the order flow, into the last sell move before the impulsive buy move that took out the major swing high points here that led to the break of structure. So the market basically actually does three things in the markets. The market moves and aims for external range liquidity, and then the market returns to aim for internal range liquidity in the form of buy side liquidity or sell side liquidity, and the market looks forward to fill up inefficiency in the market. So you can see in this bullish condition here we have a sell side liquidity, which you can also call the inducement. So you can see we have price give us the impulsive leg move to the upside, and then we have the rate of the swing high points. Price gave this pullback, created this inducement, this sell side liquidity. So price pushed further to the upside. Price created a higher high points, and then price sponsored the movement to the downside to take out the sell side liquidity resting here, so that we can have price mitigate the order flow. Because this is the last movement that actually sponsored the impulsive movements that took out this major swing high points. So you can see price return into the order flow. So at the swing low, we can actually have an order block. So you can see scenarios in the real-time chart markets where the market or price doesn't really return into the order block, but within just the order flow. And then we see price mitigate the order flow and continues to the upside. So you can see in this case here, the order flow actually was going to create a form of sponsorship candle that we call the breakout block at this particular swing high point. When we continue further into sponsorship candles, then you get to understand breakout blocks and mitigation blocks. So this is further example to actually explain the institutional order flow. So you can see we have the bullish market condition here. We have structure to the upside because you can see prices breaking swing high points. So we are creating a bullish market structure here. So what we can see is we have this impulsive leg move and we have the corrective leg move to the downside. So what you're going to see is within the pullback leg move, we have this particular sell move as the last sell move before the impulsive leg move to the upside. So now what you're going to see is this becomes our order flow, because this sell movement helps sponsor the impulsive leg move to the upside that actually took out the swing high points. So the institutions actually initiated a sell move at this particular swing high points to induce the retail traders to think that the market is actually bearish. So you induce the retail traders to consider a return of price to the upside for them to actually take a sell move to the downside. But then you can see that the institutions now pushed more orders to the upside and then took out the swing high points. So what will happen is that the institution will return to actually mitigate the order flow, because it is from the order flow that they initiated the manipulative sell move, where they now actually make price to push further to the upside as a bullish market condition. So now you can see that we have the order flow here. This is the sell move before the impulsive buy move that took out the major swing high points. So we have a break of structure. Now price pullback and then created the inducements, created the sell side liquidity. So you must understand that this is actually the sell move that sponsored the break of the major swing high points. So the institutions would definitely want to return back into the order flow that sponsored the break of structure to the upside. So this is not actually the leg move that sponsored the break of the major swing high points. So the institutions basically will treat this as an inducement, because the retail traders will be expecting to possibly see price continues when price returns to the swing low points. We want to see the continuation of price possibly to the upside, where price will return and face mitigation by a sponsorship candle here. But then what the institutions will do is they would actually raid the sell side liquidity here to mitigate where they actually initiated the buy move to the upside that took out the major swing high points. So you can see now we have price pushed to the downside. Now price mitigated the order flow. So I'll always tell you guys that you would see the cases where price return just into the order flow and not necessarily to the order block, because the order flow is actually primary. The order block is secondary. So you can now see the price pushed to the upside, and now you can see we have the return into the order flow. So you can see the same price mitigated the order flow. We have the push of price to the upside. Price created this liquidity pool. So price returned to mitigate the order flow, and now we see price project to the upside. So you must understand that in a bullish market condition, the last sell move before the impulsive leg move that sponsored the break of the major swing points is actually the order flow zone. You should look out to see price returning into to actually mitigate. So this is what you should understand about the order flow. So this is actually in the bearish market condition. So you can see in the bearish market condition, it is actually the last buy move before the impulsive leg move to the downside that breaks the major, what we call the external swing points. Because you can see we have internal swing points, which are actually internal liquidities, internal sell side liquidity. So now you can see the price took out the external sell side liquidity. So what we are going to see is in this particular bearish condition is this is actually the high point that price created. And now you see we have price gave us the bullish move and then sponsored the bearish impulsive leg move. But you can see we have price created the inducement before the break of structure. So the concept of inducement should be actually interpreted by the trader based on actually how he or she wants to actually see it. You must just understand that the market would actually create a liquidity before it breaks structure, or the market would actually create liquidity after a broken structure. So basically, price would actually aim for external range liquidity, return to fill any form of inefficiency, and aim for internal range liquidity before we see the continuation to the downside. So you can see now in this condition, price created internal range liquidity before the break of the structure. So you should expect to want to see in most cases that the market would actually aim for the internal range liquidity, raid the internal range liquidity, and then mitigates the order flow, mitigates the actual buy move that sponsored the bearish move to the downside, that actually sponsored the impulsive leg move. So that is what you can see in this bearish condition. So we have the last buy move that sponsored the impulsive bearish move to the downside. Price gave us the inducement. So this is actually a buy side liquidity. Now you can see that now price continued to the downside and then took out the external range liquidity. Now this is the last buy move that sponsored the impulsive move to the downside. Price created the internal range liquidity. So price will look forward to actually reach the internal range liquidity, mitigate the order flow, mitigate where the institutions actually manipulated traders to expect and think that the market will continue bullish to the upside. So now you can see that now price returned to the upside, took out this buy side liquidity, this inducement, mitigated the order flow, and then we have price push further to the downside. So this is not really market structure. When we get to the aspect where you are to understand the institutional market structure, I'm going to explain that better, how to mark out ideal institutional market structure. So this is for the bearish example, considering and actually looking at this from a trending market perspective, which is actually bearish. So we have the impulsive leg move, price created our internal range liquidity, price created the low points. So what you will see is that price will pull back, actually raid, sweep all internal range liquidity. So price pushed to the upside, took out the internal range liquidity, and now you can see price created the last buy move before the sell move to the downside. that took out the external range liquidity, that broke this external swing points. So now we have price created the internal range liquidity. So you must always look out for liquidities in the markets, because the market basically fulfills three things. The market takes out external range liquidity, return to take out internal range liquidity and fill up inefficiencies, and then to mitigate institutional zones. So now you can see the market took out external range liquidity. So we want to see the market take out internal range liquidity and then mitigate an institutional zone. So you can see this is the institutional zone. This is the order flow. I'm not teaching order blocks here. I'm teaching order flow. So you can see this is now the last buy move before the impulsive sell move to the downside that took out the swing low points. Now you can see the return of price took out the internal range liquidity, filled up any form of price inefficiency, mitigated the order flow, and then we have the fall of price to the downside. Price created a new low, broke structure to the downside. Price created the internal range liquidity. So price returned to the upside, mitigated the order flow. So in some cases in higher time frame, you may not really see the buy side's liquidity, but then you would see that price will return to actually fill inefficiencies. So you would see that now price return into the order flow, and then we have continuation to the downside. Now you can see price took out the swing low points, and now we have the return of price because we have liquidity resting here. We have buy side liquidity resting here in the form of relatively equal highs. So now you can see that now price pushed to the upside, mitigated the order flow, and then we have the continuation of price to the downside. So we're going to look at real-time chart example so that you can understand the concept of institutional order flow. So we're going to be looking at real-time chart example on how to actually identify institutional order flow. So we can see actually the condition of the market here is bullish, but then you can see we have the market now is bearish. So what we're going to identify is we have this institutional order flow. You can see the bearish move that sponsored the impulsive buy move. So price return mitigated this IOF and also mitigated the order block. And now we can see that price did not sponsor an impulsive move to the upside to actually take out this high. And now the condition is bearish. So we're going to dwell with this bearish institutional order flow. And one thing you must understand in the bearish institutional order flow, we'll be looking at the buy move that actually leads to the impulsive bearish move. So that is what we are identifying in the bearish order flow. So you can see that now we have the return of price to this particular order flow, and then price pushed to the upside. I told you guys that the market actually moved to fulfill basically three things: take out external range liquidity, and then take out internal range liquidity or fill up inefficiencies. So we can see that price returned into this institutional order flow. Price did not push further to take out the external range liquidity. And then we have a bearish trend to the downside, where you can see we have internal range liquidities created here. Now we can see that price returned to the upside and then took out the internal range liquidities. And then we can see that price filled up this inefficiency, mitigated the inefficiency here. So in conditions whereby you have an impulsive leg move and you can't really determine the particular ideal zone you would want to look out for to see where price is actually going to face rejection, that is where we now make use of the Fibonacci tool. So in the Fibonacci tool, we have actually the premium price and then we have the discount price. The price above the 50% level is actually a premium price, and then the price below the 50% level is actually the discount price. So you can see now would actually take from the swing high here to the swing low here. Now, what you're going to see is that we have this buy side liquidity. Indirectly, you have an order block here. So you may have the perspective of saying price may face rejection at this order block, and then we have price continue to the downside. But then you can see that price return into a premium price level. So in a bearish order flow, we're looking at selling from a premium price level. In a bullish order flow, we're looking at buying from a discount price level. So the 50% level is actually equilibrium. So you can see in conference to the premium level, we actually have the inefficiency here, which is actually what is called the fair value gap. When we continue in the next episode, you're going to understand about sponsorship candles, like the order blocks, the breaker blocks, the mitigation blocks, the fair value gaps, and other form of sponsorship candles, because they're actually imperative in identifying entry levels in a market condition. So we can see the price return into the inefficiency. Price took out all the buy side's liquidity, return into the inefficiency that is within the premium price zone. And now we can see we have the rejection to the downside. So the next thing you're going to identify is that price gave us this bearish impulsive move to the downside and then took out this low point. So what we have is we have price broke the swing low point we're seeing here, further leading down to a bearish market condition. So what you can see and identify is that we have the bullish move to the upside, and then price gave the impulsive leg move that took out this swing low points. So this is actually now our order flow zone from the swing low points here to the swing high points here. So this is now our order flow zone in this particular bearish market condition. So in the bearish market condition, you'll be looking out for the bullish move that led to the bearish market move. So we can see that this is actually the bullish leg move that led to the impulsive leg move. So now you can see that price pulled back into the order flow. So the zone we have here is actually our order flow. So within the order flow zone, we now try to identify inefficiencies. We now try to actually identify buy side liquidity based on a bearish market condition. In a bullish market condition, you'll be looking at sell side liquidity. So now what we can see is we have the break of the swing low, and then we have inefficiency in this impulsive move to the downside. Now this is the buy move before the impulsive leg move. Now what you can see is the price return into the impulsive leg move, which is actually also the order flow zone. Price return into it and then filled up this price inefficiency. So in the case where you cannot really identify where to actually look out for price rejection, just the way I've earlier said, then that is when you make use of the Fibonacci tool. So you can see we're going to take from the swing high to the swing low. So you can see we have this inefficiency is actually within the equilibrium price level. So you can see we have this fair value gap at the equilibrium price level. So what you're now going to identify is that price return into the inefficiency, which is actually in price equilibrium level. So now what we can see is that we have the order block at the extreme high points. So you can see that price did not actually return to the order block. What we can see is that price returned and then filled up this inefficiency, which is actually in confluence to price equilibrium level. And now we can see the rejection. So we do not have a buy side liquidity here because we have a very strong impulsive move to the downside. So price return into equilibrium, fill up the inefficiency, and then we have the continuation to the downside. So now you can see this is now the buy move that sponsored the sell move to the downside. So basically now we can say that this is our order flow from the swing low to the swing high points we're seeing here. So from this swing low point to the swing high point, we have the order flow. And now you can see that price fell to the downside. So within the order flow, we can identify the order block. This is actually the order block. And you can see that price did not return to mitigate the order block. Price returned into the order flow, mitigated the order flow, and then we have this fall of price to the downside. So now what you're going to see is we have price created this liquidity here. So you can see we have this return of price to the upside, which was actually created before price actually broke through the structure. So while we are actually identifying institutional market structure, you get to understand how to map out ideal institutional market structure, how to identify ideal breaker structure. So now we can see that now price created this pullback. So this pullback is going to act as an inducement because this pullback was created before an ideal break in market structure. And now you can see that now price returned to the upside and then took out this high points, acting as liquidity, acting as the buy side liquidity. Now you can see price took out the buy side liquidity. Price did not mitigate the order block. price is still within the order flow, ranging within the order flow. So now what you can see is we have a ranging market condition here. And then the last buy move that was actually created was this particular move we can see here. This is the last buy move we can identify within the range. So we have this as the last buy move, because what you can actually see is we have price push to the upside. We have this pullback, price push to the upside. We have the fall that took out this low. We have push to the upside, price came down, push to the upside, price push to the downside. We have this push to the upside, return of price to the downside, and then we have this push to the upside. So basically we're saying that this is actually the last buy move before the sell move that actually took out this low point. So this is where we have the break of this low points here. So we can see that this is the last buy move that sponsored the bearish move to the downside that took out this low points. So now what you're going to actually identify is that this pullback was created before the break of this low points, before the ideal break of structure to the downside. So basically this is now our inducements. This is now our buy side liquidity. So now you can see that now price returned into the order flow, took out this buy side liquidity, mitigated the order flow, and then we have price fell to the downside. Now what we are going to see now, let's actually map out this particular break of this swing low points. So we have the break of the swing low points. So we're going to actually identify the last buy move before the bearish move to the downside that took out this particular external sell side liquidity. So what we can see is that within the corrective leg move, this is actually a buy move that sponsored the bearish move of price to the downside. So what we're going to identify is that now we can see that this is order flow from the swing low to this particular swing high. Now we have price fell to the downside. But before price fell to the downside, we can see that price created this bullish move to the upside before we have the bearish move to the downside. But what we're going to see is that this particular movements are just within this bearish candle. So this is not really a valid pullback. So I'm going to teach us more about valid pullback in coming episodes. So, and we can also see that within this leg move, these movements are also within this bearish candle. So these are not really valid pullbacks. So basically, this is now our institutional order flow. And now we can see that price continued the movement to the downside. Price returned, price fell to the downside. Now we can see that now price returned to mitigate the institutional order flow. It gated the IOF, and then we can see the fall of price to the downside. Now what we can now see further is that price took out this swing low points here. So we are to identify the last bullish move before the bearish move. So basically this is actually our order flow from this swing low point to the swing high points here. So this is actually our order flow. So what we can see is that now this is now the order flow, and we can see that now price return mitigated the order flow, and then we have the continuation of price to the downside. So this is what I have to show you guys in identifying institutional order flow. So I see you guys in the next episode. Cheers and God bless you all.